Hi fellow learners! By clicking on this video, it means that you are finally breaking your procrastination streak and start studying for real. If you want to know what is learned in the corporate governance class in one semester, but you simply don't have the time to read the textbook, then this video is for you. The main source of reference for this course is the book by Zabihollah, Rezaee, and Fogarty, which is entitled Business Sustainability, Corporate Governance, and Organizational Ethics. A little bit of disclaimer, I am not an expert and I forgot to introduce myself. My name is Melati and I am currently in my last semester of the accounting major at my university. So comment down below what grade or what semester you are currently in. In this video, we will be breaking down the essentials of corporate governance and ethics that I have learned in one semester. Let's dive in. So there will be 3 sections, where in the first section we'll have the introduction to corporate governance and also the ethics in workplace, where in the second section we'll have the roles and responsibilities of all the key players in corporate governance, and lastly, in the third section we will have the role of technology in corporate governance, and then we will have the corporate governance in non-profit organizations, and lastly, we will have the emerging issues in corporate governance. There is no universally accepted definition of corporate governance, but corporate governance can be described as the way a company is monitored, managed, and held accountable. And it's often from the shareholders' view of what a company should or should not do. The 4 basic principles of corporate governance are accountability, transparency, responsibility, and independence. So what good does a corporate governance do to a company? So an effective corporate governance will aim for the long-term sustainability of a company, and they also protect and balance all the interests of the stakeholders in the company. On the other hand, an effective corporate governance will increase the unethical behavior and also the decrease in the financial performance of a company. The common sense governance principles that were discussed on the conference board in October 2016 are that of the board should meet regularly without the CEO, and they should have an active and direct engagement with the executives below the CEO level. Next, the directors are elected by majority votes. Board refreshment. It means that the skill set and the perspective of the directors need to remain current and updated. And it is also advised that the board composition shows diversity of culture, gender, and skills. CEO duality. If the CEO is combined with the chair role, the board must have independent directors. Investors should have access to the company's management and also board. And lastly, the management should only provide earning guidance when beneficiary to the shareholders. What is CEO duality? CEO duality is the condition where the CEO is not only the head of the management, but he also serves as the chairperson of the board of directors. So now we will discuss about the pros and cons of when a company has a dual CEO. CEO duality will cultivate a much stronger and unified leadership. The CEO can also make critical business decisions in a more timely manner, in which the approval process would be much faster. But the drawbacks is that the compensation committee would have considerations regarding the compensation of the CEO who have a dual role. There will also be a corporate governance conflict where the CEO could abuse the power and position of being the chairperson of the board. For instance, the CEO could side with a corrupt management. The audit committee would also experience a conflict of interest and credibility, where the audit committee oversee the auditing process of the CEO and management, but they also have the responsibility to report to the chairperson of the board. It will be seen as uncredible where the person's work you audited is also the person you report the findings to. The CEO would also have a reduced performance as he has two sets of tasks as the chairperson of the board and the leader of the management. The financial scandals in the early 2000s that involved the publicly traded companies such as WorldCom, Enron, and Tyco shook the investors' confidence so much on the trustworthiness of the corporate financial statements and auditors. Moreover, in this era, the auditors don't only offer services of auditing, but they also offer the services of accounting, such as bookkeeping, to the same company. And in response to this, the all too familiar with the accounting and financing students, the Sarbanes-Oxley Act of 2002 was born in response to this. Next, let's go to a smaller scale. Ethics in a workplace. In a company, why do people make unethical actions and decisions? What is the motivation behind their actions? But first of all, we need to understand whether we want it or not, other people's actions and decisions is constantly influencing our everyday decisions as well. A small illustration is when we see our colleagues always have a coffee on their hand when they are working late. And then one day we will also want to try it ourselves when we are working out late to have some coffee to keep us awake and we can work until night. We also need to understand one more thing. One more thing is that people tend to do as what they see and not do as what they are told. So next up, we will be discussing about the triangle of business ethics. Let us go over the three factors to approach ethical decision making. The first one is ethics sensitivity. The moral principles, workplace environment, gamesmanship, loyalty, peer pressure, and job security that influence one's ethical decisions and are derived from the organization's ethical culture. While ethics incentives refers to the rewards, punishments, and requirements for ethical and unethical behaviors. Next, ethical behaviors. Doing the right thing is not just about thinking, is this legal, which is a rules-based mindset, but instead, we need to think, is this right, which is a more principles-based approach. Warren Buffett once said that the 5 most dangerous words in business are, everybody's doing it. Because these 5 words, this phrase justifies a person's actions that actually should be considered as an ethical violation. He does that, so why can't I? The motivation behind fraudulent acts can be explained using the fraud triangle theory that was proposed by Donald Rezaee in 1950 and the diamond theory that Wolff and Parmensen added the additional point of capability. Opportunity refers when a person saw the loophole and the opportunity to do the fraudulent act. Next, pressure or incentives. It means the person may have a financial condition or that his supervisor pressured him to do the fraudulent act. Rationalization is when the person has reasons to justify the fraudulent act. And lastly, capability to do the fraudulent act. Here we have the findings of Deloitte and Touche for the 2007 survey on ethics and workplace that became the evidence for the fraud triangle and diamond theories. The table here shows the rank of agreements of the survey respondents to the questions and answers, in which the second row represents the most agreed answer to the questions in the first row. The questions is that the top factors in promoting ethical workplace, reasons why people make unethical actions and decisions, and the majority believes that the following actions are acceptable. Companies are encouraged to have codes of conduct and ethics programs that addresses the following points. A good corporate governance should create an ethical business environment in which all their employees are encouraged and empowered to do the right thing. The roles and responsibilities. Now, let's go over the first one, which is the Board of Directors. The Board of Directors is assigned with the oversight function, to be exact, overseeing the management. The directors are elected by the shareholders to represent and protect their interests by establishing proactive strategic missions, goals, and objectives to create long-term shareholder value and oversee managerial decisions and actions in effectively implementing the goals. Decision control, the ratification and monitoring of strategies is viewed as the Board of Directors fiduciary duty performed on the behalf of the shareholders. The fiduciary duty is defined as the duty to act for someone else's benefit while subordinating to one's personal interest to that of the other person, which is a form of selfless act. But the act of selflessness is what drives the sustainability and growth of the company, as the directors and managers has the same goal of increasing shareholders and stakeholders' value without thinking of personal gain, meaning that there is a high ethical values within the company. The primary fiduciary duties that the directors need to exercise are the duty of loyalty and duty of care. The directors also needs to exercise the duty of obedience, good faith, independent judgment, diligence, and also fair disclosure. The primary role of the Board of Directors is to safeguard the interests of shareholders and other stakeholders. The primary responsibilities of the Board of Directors are hire a competent and ethical CEO, oversee the hiring of other top executives such as CFO, treasurer, and operational managers, and then monitor management's sustainable, strategic, financial, and operational goals in achieving long-term shareholders' value, oversee the succession planning for the top executives, and replace the executives and officers if they become incompetent and/or unethical. Best practices of corporate governance suggest that the Board of Directors engage in long-term and sustainable strategic planning and decisions to improve the business, oversee the managerial operations, risk assessment, and financial reporting, engage in evaluation of the board and board committees' performance, education, and also succession planning for executives. They also need to ensure the board's independence, objectivity, diversity, effectiveness, education, and evaluation, and setting the tone at the top by promoting legal and ethical conduct throughout the company. It is crucial that the board is comprised of independent members who have their occupation somewhere else, because if it is so, then the concept of them overseeing the whole process of the management and them being independent and also have a wide view of the company's operations will be established. Next up, we have board committees. Board committees are the subsection of the Board of Directors. So the aim of the formation of Board of Committees is to improve the efficiency and the effectiveness of the areas that the directors specialize in. So essentially, the board committees are the directors themselves. but the board of directors delegate the oversight responsibility to the board committees, but they remain responsible for the oversight function. The three mandatory board committees that every public listed company should have are the Audit Committee, Compensation Committee, and Nominating Committee. In each committee, there must be at least a composition of 3 independent directors, and therefore, the minimum number of directors required to make the board committee is 9 independent directors. If it's less than 9 directors, it will be seen as being dominated and controlled by a small group, and if it's more than 15, it will be less efficient and less effective. The board committees should meet at least 4 times a year to review the reports and address important issues. Furthermore, it is sometimes advised to hold meetings excluding the managers when dealing with major issues. The individuals who should participate in the meetings are all the members of the audit committee, senior executives, internal and external auditors, and others who can contribute to or be responsible for issues discussed in the meetings. There are generally 2 types of board committees: standing committee and special committees. So the standing committees is the committees that will meet on an ongoing basis, while the special committees will only be established for a limited time period to address a specific issue or needs. The Audit Committee, which is a standing committee, has evolved as a representative of the Board of Directors to assisting the board in discharging its responsibilities in overseeing the financial reporting process, internal controls, and audit activities. There must be at least 1 member designated as a financial expert, and all members need to be independent and financially literate directors. Compensating Committee determine the compensation and benefits of directors and executives by evaluating the performance of the directors and executives. The Nominating Committee is responsible for evaluating and nominating new directors to the board by reviewing the performance of current directors, assessing the need for new directors, and identify and evaluate the skills, background, diversity, and knowledge of the candidates, and assist in the election of qualified new directors. In the selection and nomination of the new directors, the Nominating Committee will compare the desired versus the existing to determine the needed profile for competitive advantage. And they annually will determine the gender and ethnic diversity, independence, expertise, knowledge, and other attributes that are needed on the board, such as background, ethical values, and characters. The management. The management team is led by the CEO and supported by the CFO, controllers, treasurers, operating managers, and general counsel, and they are primarily responsible for operation efficiency, internal control effectiveness, soundness of accounting information system, reliability of financial reports, and compliance with all applicable laws, rules, regulations, and standards. The decision management, the initiation and implementation of the strategies, is the responsibility of the management. The directors should not engage themselves in managerial and operational decisions, or is known as micromanaging. The management is allowed to initiate strategic goals. However, it should still be approved and overseen by the board of directors. Earnings management is the management practice of timing strategy and operating decisions or choosing accrual estimates to manage short-term earnings. This practice can sometimes lead to earnings manipulation and financial statement frauds. A small example over here is that this company increases its CAR ratio by making an earlier than normal payoff of $50,000 of current liabilities. Internal and external auditors. External auditors are expected to lend more credibility to published financial statements and to mitigate the information asymmetry and the potential conflicts of interest between the management and shareholders.
External auditors are responsible for auditing the company's financial statements and providing reasonable assurance that they are free from material misstatements, presented fairly, and in conformity with the reporting standards. The relationship between the audit committee with external auditors. The audit committee has a direct responsibility to oversee the work of the independent auditor, responsible for hiring, compensating, and firing external auditors. The audit committee should also approve all audits and permissible non-audit services provided by the external auditors. There is a dual evaluation between the external auditor and the audit committee, where the external auditor evaluates the effectiveness of the audit committee and consider ineffective audit committee as material weakness in the internal control. While the relationship between the audit committee with the internal auditors is that the audit committee is also responsible for hiring, overseeing, compensating, and firing the head of internal audit department. The internal auditors are accountable and should report their audit findings directly to the audit committee. The audit committee needs to have a clear understanding of the internal auditing policies, processes, practices, and findings, which is sourced from the readily accessible and candid communication between the internal auditors and the audit committee. There are several key differences between the external and internal audits. The first difference is the level of independence. An external audit is conducted by an independent third party, while an internal audit is conducted by the company's own employees or internal audit department. This means that an external audit provides a more objective assessment of a company's financial information and operations, while normally an internal audit is more subjective. Another difference is the scope of the assessment. External audits are focused on the financial information and records, and they are usually limited to a specific period of time, such as a year. Internal audits, on the other hand, are focused on the company's overall operations and processes, and they can cover a wide range of topics such as compliance, risk management, technology, and system and human resources. The third difference is the level of detail in the assessment. External audits are usually more detailed and in-depth rather than internal audits, as they are required to provide assurance to the stakeholders that the company's financial statements are accurate and in compliance with the relevant laws and regulations. Internal audits, on the other hand, are more focused on identifying potential risks and opportunities for improvement in the company's operations. Key points regarding auditors. Independent auditors are the backbone of the auditing profession, because independent auditors provide more credibility to the financial reports by their assessment due to the fact that they are not a part of the management and they did not audit their own work results, and they do not serve in advocacy roles, which relates to the second point of the requirements for lead audit rotation, in which the audit team will be rotated every 5 years. This independency regulations and practice allows the minimalization of the bias audit conduction and reporting, as well as maximizing the effectiveness of the audit team and creating higher trust to the users of the audited financial statements. The importance of skepticism. Due to the inevitable changes in rules and regulations of auditing standards, the increase in complexity of business flow and transactions has subjected the auditors to have critical thinking and judgments to concoct reasonable alternative approaches that can be used to suit their clients in order to make a reasonable audit result. And to aid their professional judgment or skepticism, they must have the critical thinking to be aware of their own judgment, tendency, traps, and biases. Their judgment should be based on the relevant facts and circumstances known at the time, after considering alternative approaches that are reasonable, and they must keep in mind that there are certain level of uncertainty, and they must also comply with applicable professional standards. The importance of skepticism is to decrease the level of bias that they involuntarily might have due to the communication between them and the management, the higher-ups, and the audit committee. This skepticism must be paired with independence and a strong mindset that is unable to be swayed to aid the effectiveness and reliability of the audit results. The stakeholders. Corporate stakeholders are divided into 8 layers with 3 general tiers based on the stake, the rights, and the involvement that they have in the corporation. The first tier, which is the bottom in the pyramid, is the shareholders, or investors that own the company. They are the primary stakeholders because without them, the company would not exist. The second tier is the creditors. The 2 most common methods of financing are equity and debt financing. Equity financing is when the company issues shares of stock in a public offering, rendering the buyers investors and shareholders. While debt financing refers to when a company raises money by borrowing or selling debt instruments to creditors. Debt financing has becoming more common than equity financing due to the low interest rates. Traditionally, creditors have played a passive role and have gotten involved with the corporate governance only when a company violates the terms of their loan contract or misses a payment. Recently, creditors such as banks, institutional creditors, have played a more active role in corporate governance by influencing a company's borrowing credit agreements and risk management. This stimulates the company to have a good corporate governance, transparency, and accountability when reporting the financial conditions of the company, or otherwise, they would not be granted a loan. The third tier, others. Maintaining a good business reputation and meeting the expectation of all stakeholders, from investors to creditors, suppliers, customers, employees, the environment, and society. Corporate governance measures of enabling employees to serve on the board of directors, promoting diversity and customer satisfaction, and engaging in social and environmental matters can encourage cooperation between companies and their stakeholders, which will create shared value for all stakeholders. Technology and corporate governance. Technology in corporate governance has its set of pros and cons. Everything is made faster by the help of technology. It automates administrative tasks, allows us to have real-time access to data and information by promoting transparency and accountability for a faster decision-making, and reduces the risk of fraud and mismanagement. However, there are also crimes that arise from the advancement of technology. Cybercrime. With a company's confidential information and also our own personal information being stored somewhere at the internet, it is attractive to those who intend to misuse the information for personal gain. For instance, hacking to a company's protected confidential files to sell information to competitors, or a stranger uses our pictures that we post on social media to promote their products or to ask for money.
In order to balance the role of technology in corporate governance, ensuring that the use of technology is done ethically and responsibly, there will be a need for companies and the government to set clear rules and regulations and policies while keeping up with the latest trends and developments in technology. Corporate governance in non-profit organizations. As its name suggests, non-profit organizations are organizations that are not focused on maximizing profit, but instead they are focused on the social welfare of the community, and therefore they are often exempted from paying income taxes.
Non-profit organizations are established by people who voluntarily provide services such as social welfare and facilities to the people in need and the environment without aiming to gain profit for their actions, aiming for economic development instead of economic growth of the country. Typically, the state and local government, healthcare organizations, colleges and universities, charitable organizations do this as they aim to reduce the economic imbalance between the rich and the poor so that everyone can have a proper and decent facilities, as well as taking care of the environment and restore the beauty of nature. What is the difference in corporate governance between profit-oriented organizations and non-profit organizations? First, their ownership equity cannot be sold or traded. Their policy and operating decisions are made by majority vote of the appointed governing body. And they have two additional mandatory committees, which is the Development or Fundraising Committee and also the Program Committee. The issue with non-profit organization is the low public trust. A research conducted by Abidin and Rukmini in Indonesia evidenced this issue, where people with an income of 750,000 rupiahs to 1.5 million rupiahs and over refused to donate to NPOs with the reason of not trusting the people working in the NPO, they have no money, they do not trust the organization, and they do not trust the program. So the remedy for low public trust is to increase the transparency of financial reporting, publicize the results of their projects, and the government also need to set clear rules and regulations regarding the tax-exempt status of the organization. Next, we have the last topic, which is the emerging issues in corporate governance.
There has always been issues regarding corporate governance, may it be issues that has been around for a long time or emerging issues. So the issues that has persisted up until to this day are, the first one, the compliance issue. It is a challenge for a company to have an effective compliance and implementations of the policies, rules, and regulations that is set by the company itself or the government. Next one, we have the challenge for the nominating committee, where they see when the CEO has no longer performing as well as he did before and is thinking of replacing him to a new CEO. The previous CEO or the current CEO will feel very reluctant to be replaced. Why? Because they feel that they have put so much effort managing the company, and how could they easily entrust a new person to take over his job? So most of the times, people will feel that they are the person that cannot be replaced.
Some might feel that nobody will ever be a good enough replacement to carry on his responsibilities. Next, we have the challenge for a compensation committee, where the issue lies on the reasonableness of executive compensation, recognition of stock-based compensations as a compensation expense, and illegal backdating. This illegal backdating refers to the practice of setting the grant date of a stock option to an earlier time when the stock price was lower, and thus providing the recipient with an immediate unwarranted profit. So, it is important to ensure the independence of the compensation committee. And next, we have the board leadership issue, where I have explained in the previous section about the CEO duality, the pros and cons of the separation of the roles of the chairman of the board and the CEO. The emerging issues of corporate governance are that of the corporate governance reforms should create an environment in which public companies can operate in creating shareholders' value, and not only that, they also need to protect the interests of other stakeholders other than the shareholders and rebuild the investors' trust through effective enforcement of these reforms. The regulations must also be cost-effective, efficient, and scalable. The new corporate governance reforms should address the systematic risk of all business transactions and particularly the risk of business failures and potential insolvency. They must once again protect the interests of all stakeholders including investors, government, customers, creditors, suppliers, employees, and society, and promote accountability for businesses and their directors and officers, and lastly, encourage convergence and global cooperation and coordination.
We have reached the end of this video. Don't forget to like, subscribe, and comment down below what topic should I cover next. Thanks for joining me on my corporate governance and ethics course. I hope that this video helps to enrich your learning journey. See you in my next video.